Hello, everyone. My name is Ryan Woolhiser, and today I'll provide an overview of key economic and market data from the fourth quarter of 2024, focusing on trends and insights that impact investment decisions. We'll cover market performance, macroeconomic trends, and highlight key charts that reflect the current economic environment. Let's start with market data. This section includes performance analysis of major stock market indicators and various asset classes over the past quarter. For example, the S&P 500 posted a Q4 return of 2.07%, while the Dow Jones and NASDAQ returned 0.51% and 6.17% respectively. Our goal is to assess how different segments of the market performed during Q4 of 2024. Looking at key indices, the S&P 500 was driven primarily by growth in the technology and consumer discretionary sectors. The Dow Jones was supported by industrials and healthcare. The NASDAQ heavily weighted in tech stocks, which outperformed, reflecting investor confidence in AI and innovation-driven growth. Global indices did not fare as well due to policy implications from the election and potential tariffs, with the MSCI World, excluding the US, return being down 7.36%, the MSCI Emerging Markets return being down 7.84%, and the MSCI EFA being down 8.06%. This table shows the performance of asset classes over different time frames. US growth was the best performing asset class on this heat map with a 7.1% total return in Q4, placing it as the best performing asset class in the last 6 months, 1 year, 3 year, 5 year, and 10-year time frame. Commodities were the only negative asset class in Q3, but rebounded with a 3.8% total return in Q4, which puts it as the second best performing asset class on this table. Fixed income as an asset class slipped due to spiking yields on the longer end of the curve. World, excluding the USA, US real estate and emerging markets took the biggest tumbles in Q4. This slide points out total returns and max drawdown, so peak to trough of various risk versus return strategies or asset allocation mixes, which includes a blend of the S&P 500 and the Bloomberg US aggregate in allocations of 100, 0, 80, 20, 50, 50, and 20, 80 in 2024. Those allocation returns respectively for an all equity portfolio were 25.02%. For the aggressive 80-20 portfolio, it was 20.01%. The balanced at 50-50, up 15.13%, and a conservative portfolio, 2080, up 5.75%. Looking at the max drawdowns over the same time frame, the S&P 500 saw a negative 8.45% max drawdown, with aggressive portfolios down 6.35%, balanced portfolios down 4.46%, and conservative portfolios down 2.97%. Growth stocks outperformed value stocks this quarter, with growth returning 7.07%, while value stocks saw a modest decline of negative 1.98%. Small cap also led the way with a 2.75% return, highlighting a change in sentiment with the election outcome and potential deregulation and lower taxes. The current price to earnings ratio for the S&P 500 stands at 27.92, above the historical average of around 17.54, indicating elevated valuations. Forward earnings estimates suggest a potential growth rate of 4%, based on the S&P CAPE ratio, which is the cyclically adjusted price to earnings ratio reflecting averages over the last 10 years adjusted for inflation, influencing future market trends. Moving to the macroeconomic indicators, we'll analyze inflation, employment, GDP growth, and consumer spending. Inflation remained within the Fed's target rate, which, while elevated, showed signs of stabilization compared to previous quarters. Inflation increased by 2.89% year over year, with core inflation, excluding food and energy, at 3.24%. Real wage growth, however, moderated slightly to 0.99%, reflecting a cooling labor market. The unemployment rate held steady at 4.10%, primarily driven by gains in the service sector. The labor force participation rate remained at 62.5%, showing resilience despite economic uncertainties. Leading economic indicators signaled a potential for slowdown, with the Philly Fed Manufacturing Activity Index declining by 10.9% in Q4. GDP consumer sentiment has seen an uptick more recently as consumers feel more optimistic about the economy, reflected by little change in retail sales. GDP growth for Q4 stood at 5%, exceeding analyst expectations, but raising concerns about sustainability given rising debt levels. However, the continued reliance on debt and our ability to service this at an elevated rate could be a future concern, as it has grown to over $35.46 trillion. With our debt to GDP now just over 120%, as it has grown over the last several years, but still below the high of 132.96%, as seen in Q2 of 2020. As we discussed earlier, consumers continue to spend, which is good. However, personal savings rates are below the historical average of 8.58% at 4.3%. Outstanding consumer credit has also grown substantially over the last couple of years to over $5.102 trillion, creating a bit of concern. Bringing us to our final slide with the chart of the moment surrounding index concentration. The top 10 holdings in the S&P 500 now account for 37.32% of the total index, indicating increasing market concentration. In the NASDAQ QQQ, the concentration is even higher, with the top 10 holdings representing 51.08%, underscoring the dominance of megacap tech companies. Thank you for your time today. I appreciate you listening to our video.